double exponential moving average. Now we're going to talk about two additional moving averages, the double exponential and the triple exponential moving average. And what it is that it is really just a modified version of the standard moving average. So it actually uses the standard exponential moving average. It creates some combination of it in order to create this new indicator called the double exponential moving average. And what it does is that it looks to reduce the time lag and identify trends more quickly as compared with the standard exponential moving average. So really these are trying to be improvements on the standard indicators we've already discussed. And the word double, the fact that we have the double EMA or the double exponential moving average, comes from the fact that as part of this we have to calculate the moving average of the moving average. So we're going to take the EMA or the exponential moving average of the first exponential moving average. And that's how we come up with the word double exponential moving average. So let's take a look at the formula on the PowerPoint screen. So what we see is a DEMA or DEMA, and that would be for n days. So just like with the moving average, we have a 10-day or 50-day moving average. The same would be of the double moving average. And the double EMA is calculated as 2 times the standard EMA. So when you see EMA on the right-hand side of the equation, this is referring to the normal EMA that we learned in the last lecture. So it's 2 times the standard EMA minus the EMA of the EMA. Okay? And what this means is that we're going to calculate the exponential moving average of the exponential moving average. So if you think about it, the exponential moving average is just a series of prices, right? It's a series of prices based on the calculation of something else. And then we're just going to take an EMA of that series, right? So we're taking an EMA of the EMA, and that's the double EMA. Now we understand how to calculate it. How do we actually use this? Well, when we trade, the double EMA is actually used in the same way as the EMA or the simple moving average. Essentially, it's just another way of calculating the moving average, and we can use it for a trading strategy in the same way that we learned in the last lecture. So for example, we can do our moving average crossover strategies using double EMAs, or we can do our triple crossover strategy using double EMAs. So essentially, this is just another indicator, another moving average indicator that's used to identify the trend. Now what we are going to do now is go into Excel, and we're going to actually calculate this just so we can see how to do it so that you can do it for yourself. And one reason I feel this is quite important is that a lot of these other indicators are not available in standard charting packages. So if you, for example, go to Yahoo Finance, you will not find a double EMA. If you had an advanced software that you paid for, you would probably find it, but in general in free software it may not be available. So this way, at least if you don't have that advanced software, you can still calculate it yourself. So we'll go and see exactly how to do that. Double exponential moving average. Now here we are in Excel, and what we are going to do is calculate the double exponential moving average. And as I said in the last slide, this indicator is not going to be available on a lot of packages, free technical software packages, so it's really important for us to be able to calculate it. And anyway, I think it's good for us to know how to calculate it and do it in Excel, because that's usually preferable to using a chart, because you can see exactly how much profit or loss you would make from a particular strategy. We have the same price series that we had before. So this is again the Nifty index, the value of the Nifty index from 2005 until the end of 2011. So the same data set that we used in the last lecture. And I'll be using the same one just so we can be consistent and see how it works. And what we're going to do now is calculate the double exponential moving average. Alright, so you can follow my cursor along. I'm going now to the double exponential moving average tab. And in here, what I first need to do is calculate the exponential moving average, right? Because the double exponential moving average uses the exponential moving average as part of its calculation. So we'll just do the EMA for 20, let's say. So we want to do the EMA for 20 days, okay? And if we remember how to do this, I need to copy this one value across, and then what I do is that I calculate the EMA in this way. So it's going to be equal to the price minus the previous EMA, alright, multiplied by 2 divided by the number of days of moving average will be 20 plus 1. Okay? And then we take all of that and we add it to the previous day. And this will give us the value of the EMA of 20 days. So then what I need to do is take this value and copy it all the way up. Alright? I go up here and now I have the 20-day exponential moving average. In order for us to calculate the double exponential moving average, we need to first calculate the EMA of the EMA. Right? So we need to find the EMA of this column here. So I'm going to label this EMA of EMA, and this will be EMA 20 of EMA 20. Okay? And this will follow the same formula that we used before. So again, I'll just copy this one value across, and then really it's just going to be this same formula here. Alright, and it's using the right values. So I'll take this and copy this all the way up here. Now that is the EMA of the EMA. And with that, we can then calculate the double exponential moving average. So this is DEMA 20 days. And this will be equal to 2 times the EMA. Alright? And then we subtract the EMA of the EMA, which is there. Alright, and I copy this all the way down, and that gives me my double exponential moving average. So as you can see here, it's a fairly straightforward calculation. What's really important is that we need to just calculate the EMA of the EMA, which we did. And once we've done that, we can simply use the formula for the double exponential moving average. And as we mentioned earlier, this can be used just like the normal exponential moving average for any kind of moving average strategy that we're interested in implementing. Okay? So really it's not going to be that different than the normal moving average in terms of implementation of a strategy. It's just that it's slightly more different or difficult to calculate. Alright, let's carry on. Triple exponential moving average. Here we are now again with a new moving average indicator. This is the triple exponential moving average, and it follows very much the same logic as the double exponential moving average. And it is of course a variation of the double EMA as well as a variation of the EMA itself, and it looks to do very much the same things as the double EMA, but do it another step further. So again, it looks to reduce the lag inherent in the moving average formula. And this is a slightly more complicated formula because what we have to do is now calculate the EMA of the EMA of the EMA. So we need to really do it 3 times instead of just twice, right? So if you remember when we went to Excel on the previous in the previous slide, we did the EMA of the EMA. For this formula, we need the EMA of the EMA of the EMA, and we also just need the EMA of the EMA to begin with. So we need to do all of these things, and then we'll come up with the triple exponential moving average. Let's take a look at the formula. So what we can see is that the triple exponential moving average is equal to 3 times the EMA minus 3 times the EMA of the EMA plus the EMA of the EMA of the EMA. And that's the triple part. Alright? So again, it's a slightly more complex formula, but it's really not conceptually more difficult, right? It's just a few more terms in the equation. But again, we're just calculating EMAs of EMAs, and in this way we can come up with the triple exponential moving average. I just want to say a quick word about it before we go on to Excel. What we're going to show you how to calculate it in Excel, just like with the double EMA, is that these are just moving average indicators. Right? You can treat them just like moving averages. You can use them for moving average crossover strategies because It's important to know that they're not some special indicator. They are a little bit different. They should respond to trends a little bit earlier than the normal moving average. So in that sense, they're a little bit more beneficial. But of course, we know that any indicator that responds earlier also has the probability of greater false signals and greater whipsaws. So these are improvements and variations on the previous indicators, but that doesn't mean they'll always be better, right? Sometimes the simple EMA might be the best indicator. So it's important just to treat this as another indicator, not something that's, significantly an improvement on the previous one. Although in most cases it should be an improvement, but it may not always be the case. Alright, so let's now go into Excel, and we can go ahead and go through the procedure of calculating the triple exponential moving average. Triple exponential moving average. Here we are back in Excel, and we're now going to calculate the triple exponential moving average. So we'll start from scratch. So let me go to the next tab, triple exponential moving average. And what we'll do is we'll again calculate it for 20 days, so the 20-day triple exponential moving average, and then we'll see what it looks like. So first what I need to do is calculate the EMA 20, which I did earlier, but I'll do it again. Then I will need the EMA of the EMA, right? And finally I will need the EMA of the EMA of the EMA. Okay, so these columns will become a little bigger, but that's fine. So how do we do this? Well, we know how to do the EMA, of course. Copy this one value across, and then I simply take the EMA is equal to the price minus the previous day's EMA times 2 divided by the number of days, which in this case will be 20, plus 1, and then plus the previous day's EMA. So I can take this all the way up, paste it there, and this is now the EMA of the series, the EMA 20, which we already know how to do. Next, we'll calculate the EMA of the EMA. So again, it'll be the same formula. You can see here we're using the right numbers. Alright, and we'll take this all the way up. This gives us the EMA of the EMA. And finally, we'll do the EMA of the EMA of the EMA. And again, that's going to be the same procedure as before. Copy this formula across, and then take it all the way up. And there we have it. Now we have the EMA of the EMA, and we have the EMA of the EMA of the EMA. And now what we can do is finally calculate the triple exponential moving average. And as we said, this formula is slightly more complex than the other ones, so let's go ahead and do this. In order for us to calculate the triple exponential moving average, I'm first going to write it in here. Alright? The triple exponential moving average, if we remember the formula, if you don't remember, that's fine, because we'll see it now, is equal to 3 times the EMA. Alright, and this I'm going to put in brackets, minus 3 times the EMA of the EMA. Okay, I think I have the brackets the wrong way around, but that's okay. There we go. And then plus the EMA of the EMA of the EMA. And this becomes our triple exponential moving average. So let me copy this all the way down. And now we have this full series. So there we have the triple exponential moving average. We can see that, again, it's slightly more complicated to calculate as compared with the double exponential moving average. But as long as we do it in steps, then it becomes fairly straightforward. So what I would recommend is whenever we're calculating something that involves many terms, like in this case we need the EMA of the EMA, and we also need the EMA of the EMA of the EMA, it's a good idea to calculate these separately. So as you can see, I've put these in separate columns, and then calculating the triple EMA becomes very easy once we have these columns. Of course, you don't have to do it this way. You can calculate it all in a single formula, and that's fine too. I'd like to do it this way because then it shows me my calculation step by step. So I know that if I make a mistake, it becomes easier to correct because I've broken it up into smaller steps. But by no means do you have to do that. You can do it all in one formula, or you can do it over multiple. I recommend if you're starting out to do it in multiple, because just to make sure you know how to calculate each part, and then you won't have a very, very large formula whereby it's difficult to detect if and when something goes wrong. Alright, so now we'll end with our discussion of the double and triple exponential moving averages. We're going to now talk about the moving average convergence divergence, which is a different indicator and trading strategy associated with it. Moving average convergence divergence. Moving average convergence divergence, also known as MACD. So the way to pronounce this, by the way, is MACD. You've probably seen this before. This is a fairly common indicator. It is available on a lot of different technical analysis software, including Yahoo Finance. So we will take a look at it. And what I want to do is explain what this is. And what the MACD is that it consists of 3 separate indicators. So the MACD actually gives you 3 different values when you use it. And all of those together are combined to form a trading strategy. And the MACD is actually very, very easy to understand. It is just a manipulation of the moving averages. So it's going to be like we did with the double and triple exponential moving average. We're going to take the moving averages and do some calculations with them in order to come up with the MACD. So the MACD line, so as we said, we have 3 separate indicators. They are the MACD line, the signal line, and the divergence. So let's go through each one. The MACD line is the difference between a fast EMA and a slow EMA. So this is with when we're doing moving average crossover strategies, we have a fast EMA and a slow EMA. So the MACD line is just the difference between the two. Alright, so in this case EMA M, that'll be the fast one, and EMA N will be the slow one. So that could be, let's say, 5 days and 20 days, or 10 days and 50 days. Alright? The signal line is the EMA of the MACD line. So the signal line will be a moving average of this MACD line, which we've calculated before. Okay? And finally, we have the divergence, which is the difference between the MACD line and the signal line. So the divergence equals MACD minus signal. Now again, this may seem a little bit overwhelming because we have 3 different equations here, and we have lots of EMAs, but if we just go through it step by step, we can see that it's actually not that simple. We need to start with 2 different moving averages. So we start with a fast moving average and a slow moving average. We use that to calculate the MACD line. Once we have the MACD line, we take an EMA off that MACD line to get the signal line. And then the divergence will just be the MACD minus that signal. Alright? Moving average convergence divergence. As we said, the MACD is composed of moving averages. And as we know with any moving average strategy, its main function is to identify the direction of the trend. Now let's talk about how exactly we use the MACD in a trading setting, right? So as a trading strategy, how exactly do we use the MACD line and the MACD strategy? So what we're going to do is the main things we're interested in are the MACD line and the signal line. So if you remember, the MACD was the difference between the 2 moving averages, and the signal line was an EMA of the MACD line. And what we do is that we essentially use those 2 as our moving average crossovers. So when the MACD line crosses above the signal line, then we have a buy signal. So essentially when the MACD line goes above its own moving average, that's a buy signal. And when the MACD line crosses below the signal line, that's a sell signal. Alright, so you can think of this as just a moving average crossover strategy, except we're going to be using the MACD line and the signal line as our fast and slow. Alright, because one is a moving average of the other. So really, in implementation wise, it'll be the same as with the moving average crossover, except our indicators will be calculated a bit differently. Right, so the crossover part is the same, but the calculation of the indicators will be slightly different. Now of course, as with most moving average strategies, they tend to work best when markets are trending. Alright, and they work poorly in non-trending markets. And this is something we've stressed about for all moving average strategies, is that they tend to work well in trending markets. So this is obviously not a surprise for us, but just keep this in mind for the MACD strategy as well. And because this is an indicator that's available on Yahoo Finance, we'll actually first go to Yahoo Finance and take a look at it graphically on the chart. Once we have looked at it on the chart, then we will go into Excel and actually calculate the MACD line, and we'll also do the strategy. So we'll actually calculate the trading strategy and see how profitable it is, much like we did in the previous lecture with the moving average crossover and the triple crossover strategies. Moving average convergence divergence. Now we are now in Yahoo Finance, and again we have the same chart up, or a very similar one to the one we had in the previous lecture. It's the Nifty index from July 2011 to July 2012, and what we're going to do is show the MACD indicator and see what it looks like on the graph. Alright, and look at it visually and see exactly how we would implement that strategy from a visual perspective. So you can follow my cursor now. If you go into technical indicators up here, you can see MACD. Alright, we'll click on that, and now we have three different parameters we need to input. Okay, so we have the slow moving average, we have the fast moving average, and we have the signal, right? That's going to be the signal line, what moving average it uses. So we're just going to stick with these defaults here. So we'll use 26 days for the slow moving average, we'll use 12 days for the fast moving average, and we'll use 9 days for the signal EMA. So now I just click draw. Alright, and now here in the bottom I have the MACD lines. So you can see up here there are three different indicators. There's MACD, there's the EMA, that's the signal line, and there's the divergence between, it's just the difference between the two. Alright, and really what we're going to be doing is that we're going to use this red line and blue line as a moving average crossover strategy. So the blue line is the MACD line and the red line is the signal line. And what we're going to do is when the MACD crosses the signal line and goes above, that's a long position, and when it crosses and goes below, that's a short position. Right, so the first crossing, now you're going to have to look very closely here because these lines actually move quite close together. The first crossing occurs over here. Alright, so at this point we would take a long position and we would hold it up to here and we would close it out around here. So we'd make probably a very small profit or not much at all for that position. Then here we would take a short and here we would close it out. Again, that would not give us much either. Here we would take a long position and we would hold it all the way until here, and this would be fairly profitable. Alright, then we would have a short position here. This would also be fairly profitable, close to profitable a little bit. And then you can see again when we go to this long one, we actually get the signal all the way over here, which is quite earlier than a lot of the other moving average indicators. And we'd hold this all the way until here and make a very good profit on that uptrend. So you can see the MACD line does a good job of finding these trends quite early. And then, you get the idea of how this works. We keep taking positions as the crosses take place. Alright, so now what we'll do is we'll go into Excel and calculate it over there, and we'll actually implement the trading strategy to see exactly how it does. Moving average convergence divergence. Here we are back in Excel. Now what I will do is go on to the MACD tab, and again we just have the Nifty index. So what we're going to do is we are going to calculate the three different MACD indicators, so the MACD line, the signal line, and the divergence, and then what we're going to do is implement a trading strategy. Alright, now first we'll just use the same parameters that we saw in the chart. So we'll just use the EMA 12, we'll use EMA 26, okay? With that we'll calculate the MACD line, so we'll call that MACD. Then from that we will have the signal line, which will just be an EMA of the MACD 9, so I'm going to put signal 9. And then finally we'll have the divergence. Alright, and after that we'll actually do the trading strategy and see how it performs. So let's just do these calculations. So the EMA 12, we'll copy this value across, and we know the EMA formula is equal to the price minus the previous day's EMA times 2 divided by, in this case it's going to be 12 days, so 12 plus 1, all of that plus the previous day's EMA. So I can take this and I'll copy this all the way up. And now we'll do it for 26. So let me just copy this formula across, but I'll need to change a few things. So again, we want to use column B because we're calculating the EMA of the original price series, and we want to use 26 days instead of 12 days. Alright. Take this all the way up, and we have the EMA 26. So far so good. We've calculated the EMA 12 and we've calculated EMA 26. The next thing we're going to do is calculate the MACD line. And the MACD line is very simple. It's going to be equal to the fast EMA, or EMA 12, minus the slow EMA, or EMA 26. Alright, and that's the MACD line. And then I just have to take this all the way down. Alright, and you can see that it's negative sometimes and positive sometimes and then negative, which is what we expect. And finally we have the signal line, which is now an EMA of the MACD, and it's a 9-day EMA of the MACD. Alright, so let's use the formula for the EMA, which we know. So let me start by copying this value across. This value is 0, so I'm just going to put 0 over here. Okay, and then the EMA is going to be equal to the, well, we know the formula, so it's going to be equal to the price minus that, minus the previous day's EMA, multiplied by 2 divided by, in this case it's going to be 9, because we're using a 9-day for the signal line, 9 plus 1, and then finally we add the previous day, and then I simply take this all the way up, and I now have my signal. So I'll expand that so you can see the values, and then this becomes the value of the signal line, or the EMA of the MACD line. And finally, what we need to do is calculate the divergence. So the divergence is, again, a simple calculation, is equal to the MACD minus the signal line. And I can take this all the way down. Alright, and you can see it's going to go from positive to negative. And now the beauty of the MACD strategy is that we really just need to look at the divergence to know when to take a position. So remember, whenever the MACD is above the signal line, we should have a long position. Whenever the MACD is below the signal line, right, we need a short position, right, if you remember from the graph. So what we're going to do is actually just use the divergence to do our strategy. So whenever the divergence is greater than 0, right, so whenever the divergence is positive, which means that the MACD line is greater than the signal line, whenever that's positive, we'll say that we have a long position, and whenever it's negative, we'll say that we have a short position. Okay? So first what we'll do is we'll do something similar to what we did before. We'll actually just calculate the absolute returns on the index. So the return for the Nifty index is simply going to be equal to the most recent day minus the previous day. And this, if you remember, was what we calculated before. Alright? And we have to take out this last value here. And what we're also going to do is only calculate up to 2006, because we want to keep some of it for actually calculating the data. Alright, so I'll just take it down to 2006. I'm not going to bother chopping it all off like we did last time. You can if you want to, but there's no need to do that. And then we have the position, right? So this will be, do we take a long position or a short position? And what we're going to do is we're going to look at the divergence of the previous day, alright, to take that position. And remember, if the divergence is greater than 0, then we have a long position. If the divergence is less than 0, then we have a short position. So my position will look like this. If this divergence value is greater than 0, then give me long, which is 1. Otherwise, give me a short, which is -1. So this should give me a long position because in this case the divergence is positive. Now I'll take this all the way down and I'll see lots of 1s and some -1s. And what I'm just going to do is I'm going to just take this up to 2005. Right? So from here I'll get rid of all of that and we'll start with this position here. Alright, now we have the position, and the next thing we need to do is calculate the return. So this is going to be the MACD return. And now what we're going to do is take the position multiplied by the return, alright, for that day. Do that all the way down, and now I get their different returns on different days. And if I sum this, I'll see I'll end up with a positive return. So these are all zeros, so it's okay if they're summed. Right, you can look at this sum down here. It's 719. So I have a positive return from following this MACD strategy. 719 is not a very good return. So even though the return is positive, it's actually the case that the buy and hold return is a little higher, which we know from the last lecture. But this is just to give you an idea of how the MACD strategy works. So what we'll need to do, obviously, when we're implementing this is optimize it, right? So we need a way to actually figure out what are the right lengths of moving averages to use. So in this case, we used a default 12, 26, and 9. But you can use a variety of different numbers to see what works best. And also in different market conditions, right? We need to know whether the market's in a trending condition or not. So there are many other filters and rules we can apply to improve this. And this is the case with the other moving average strategies we did in the last lecture. But really the purpose of this is to show you how it works and how to calculate it. So our optimization process and the process of actually finding what works best, that will be in the last module, Technical Trading Systems. This is more to introduce you to the indicator. So what I would obviously recommend, as I recommend with all the Excel parts, is that you go ahead and replicate this for yourself, right? So you take the Nifty data, hopefully you did that with the last lecture too, and then calculate the MACD, and then calculate the return from following a MACD strategy. And you can use the same numbers to see if you get the same thing, or you can use different numbers to see if you come up with something different. But here it is, and it's fairly, again, it's not too difficult. It just requires a numerous numbers of steps, but you can go through this at your own pace, and then we can calculate the returns from a MACD trading strategy. Percentage price oscillator. So now we're going to talk about another indicator that's called the percentage price oscillator. And it's actually very, very similar to the MACD. And it's an extension of the MACD, and it's used in very much the same way. So what we do with the PPO, or the percentage price oscillator, is that we take the MACD and express it in percentage terms rather than absolute terms. Now if you take a look at the PPO formula, what you see is that the PPO is equal to the fast moving average minus the slow moving average divided by the slow moving average. And you can see this is very, very similar to the MACD calculation, right? We have the top part, the numerator of this equation is actually the same as the MACD line. The only difference is that we're going to divide it by the slow moving average. So what this does is that it expresses the MACD that we have in percentage terms. So we're looking at how much does the short moving average differ from the long moving average in percentage terms rather than absolute terms. Right, so just the MACD line will look at just the absolute difference between the two moving averages. This will look at the difference between the two moving averages in percentage terms. Now let's think about why we might want to do this. Well, the fact is that if we're just trading a single asset, right, we saw when we did it on the Nifty that it was straightforward to just use the MACD line. But what happens when we want to compare different assets? Right, let's say I want to compare the Nifty index and the Sensex, the BSC Sensex. Well, the thing is, the BSC Sensex, the values are much greater, right? It trades at a much higher number in absolute terms. So the MACD values will also be a lot bigger, right? Because the differences will be bigger because the absolute movements are larger. And then if we wanted to compare the two, right, we wanted to know the differences. Let's say if we're comparing the Sensex and the Nifty and comparing their strength of each of their trends, we wouldn't really be able to compare the two MACD indicators. But with the PPO, because it's in percentage terms, we can do that. Right? By putting it in percentage terms, it standardizes it so that we can compare it across different assets. So not just if we use two indices, but if we have two different stocks, or if we have many different stocks within an index that we want to compare. Right? The PPO is a way for us to actually express the MACD, the same thing that the MACD is telling us, but in a way that allows us to compare it to other assets. So what we're going to do now is we're going to go back into Excel and we're going to see how to calculate the PPO. And it's not going to be that difficult, but we're just going to go through it anyway, just so we get more practice. Right? A lot of this is actually practice. The more we do it, the better we get. So we'll go back to Excel, we'll calculate the PPO. We won't do the trading strategy this time, but we will calculate it, and just to see how to do it, and so that you can also calculate it for yourself at home. Percentage price oscillator. Here we are once again back in Excel, and what we're going to do now is look at the percentage price oscillator, and we'll calculate this and show you how to do that. So let me go back to this PPO tab. And again, we have the same data set as before. We have the Nifty index from 2005 until 2011. And what we're going to do now is calculate the PPO. So we'll use the same two moving averages that we did before. So we'll use EMA, the 12-day EMA, and we'll also use the 26-day EMA. I'm not going to bother doing the signal line and the divergence because that's going to be exactly the same. I just wanted to show you the PPO indicator. So first we need to do EMA 12, and then we need EMA 26, and then we'll get the PPO. Alright, so let's go ahead and do this. And we're doing so many EMAs now, hopefully you should be able to do these in your sleep. Well, not quite, but hopefully you'll do them enough that they'll become second nature to you. So again, the EMA is going to be equal to this value here minus this initial value, then we multiply it by 2 divided by n plus 1. So in this case, the number of days is 12 plus 1, and then we add the previous value. Take this all the way up and copy it there, and now we have our 12-day exponential moving average. The next step, of course, is to calculate the 26-day exponential moving average. So again, we're going to do the same thing. I'm just going to copy the formula across and change a couple of the parameters. So we want to be obviously using the initial price, which will be B instead of C. And instead of 12 days, we'll have 26 days. And otherwise, of course, it's the same calculation. So I take this up, copy this across, and now I have my EMA 26. So this is now the 26-day EMA. So to calculate the PPO, if we remember the formula, it's going to be the fast moving average minus the slow moving average divided by the slow moving average, right? And it's going to be in percentage terms. So I'll take this, the EMA 12 minus EMA 26, and all of that divided by EMA 26, and this gives us the PPO. And what I can do is I can click percent here, so this gives it to us in percentage terms. So this is now 2%, and perhaps adding a decimal would be quite helpful here. Alright, so there we go. So now we can see the value of the percentage price oscillator. Now again, this is not too difficult to calculate if we know how to do the MACD. It's just a very simple extension of that. I just want to make a couple of points about the PPO, is that we can actually use the PPO instead of the MACD if we want to. The only thing is when we calculate the signal line, we should really be using, we can actually use the PPO as well to calculate the signal line. It wouldn't cause any problems. It would give us the same buy and sell signals were we to use just the MACD line and the signal line. So we could do a signal line of the PPO that would be take the EMA of the PPO and calculate it that way, and we should end up with something that's fairly similar. And then we can use that, of course, to create our trading strategy. So as we said, over one asset, it doesn't make a difference to use the PPO or a MACD, but when we compare assets, it does. So if we want to look at the strength of two different trends, two different assets, say we're picking between the two, and which MACD or PPO indicator is stronger, then using this PPO will help, because we can then just compare the percentage terms. So it's really important whenever we compare different assets that we compare PPOs. We don't compare MACDs, because MACD will uses absolute numbers, and that doesn't really make sense when you're comparing two different assets. It makes a lot more sense to compare them in percentage terms as opposed to comparing them in absolute terms. Okay, so now we have had a chance to go through these few indicators. We're going to spend the rest of the lecture going through some additional indicators that will also help us to talk about trends and to find trends. And again, the same pitfall is going to apply. These indicators will work well when markets are trending, and they will also not work very well when markets are not in a trend. But, just remember that already. I know you already know it, but I want to keep stressing it. And now let's carry on. Average directional index. Now what we're going to do is talk about a couple of other indicators. And the next few indicators we will talk about are indicators that are normally used only as confirming indicators. So the remaining three indicators we'll talk about. So the average directional index is one. Then we'll talk about the advanced decline line, and then we'll talk about the parabolic SAR. So these three indicators are all indicators that are normally used in conjunction with other indicators. And what this means is that they are used to help us identify whether a market is trending or not. And if so, what is the strength of that trend? So it's very, very different to other ones where we actually use them in particular strategies to come up with a buy or a long or short position. Like with the MACD, there's a particular strategy to use with the MACD. But these are really telling us about whether the market is trending in the first place. So I know, we always talk about the fact that these indicators work well when markets are trending, and they don't work well when markets are not trending. Well, these are some indicators that can tell us whether the market is trending or not. And specifically, the average directional index is one of them that tells us whether the market is trending or not. So this one, as well as the advanced decline line, these two in particular are going to be about telling us, is the market trending? Is it a strong trend? Right? We want to know whether the trend is weak or strong, right? And if it's a strong trend, then we should use our other indicators in order to take a position. If it's a weak trend, then perhaps we don't want to end up taking a position, and that maybe the moving average indicators will not work so well. Alright, so let's talk about the average directional index first. The average directional index is an indicator that is between 0 and 100, alright, and it measures the strength of a trend but not the direction. Now what this means is that as the numbers go higher, right, it indicates a stronger and stronger trend. Lower numbers indicate a weaker trend, but they don't tell us anything about the direction of that trend. They just tell us how strong the trend is. So we need to use other indicators like the moving average, for example, to give us the direction of the trend. This just tells us the strength of the trend. So this could be for an uptrend or a downtrend. Now, how do we calculate this? Well, we use the highs and lows of prices over a period of days. Now, for the next three indicators in the remainder of this lecture that we're talking about, I'm not going to go into the calculations of these. That's because they can be fairly complicated and involved, and it would take up a lot of time. So I don't think it's worth going through them. But, you can look them up and find out how to do them if you're interested. This indicator, the average directional index, for example, is not always on standard statistical technical software like Yahoo Finance. It's not there. So you might have to find a way to calculate it or use a technical software that has it. But unfortunately, we're not going to be calculating it. That's because it's going to be too cumbersome and it's a fairly complex calculation. It's better we don't have to calculate this because we don't anyway use this to create the trading strategy in the first place. It's just used to measure the strength of the trend, right? So we have this indicator that's between 0 and 100. So if we see the ADX value below 20, what this means that the market is not trending, right? So below 20 is a very, very weak sign. It means that we have a non-trending market. Now, whenever we see an ADX value below 20, what we should be thinking is that our moving average indicators may be telling us that, we should buy or sell, but this ADX value is saying, hey, you know what? The market's not trending, therefore we shouldn't take a position. So these are really ways to help us implement our moving average and improve their strategies. Okay? Now if we have, when the ADX crosses above 20, it indicates the start of a new trend. Right? So as we said, the higher it goes, the more likely we are to have a trend in place. So whenever we have an ADX value of 30 or above, that indicates a fairly strong trend in place. So above 20 indicates a start of a new trend, right? So possibly that we'll have a new trend that's going to carry on. And once we cross 30, then we are confirmed that we are in fact in a strong trend. And the ADX is a lagging indicator like all the others, right? Like a moving average, it's a lagging indicator. So it will only tell us that we're in a trend after it has already occurred, or will tell us that we're not in a trend after the fact has already occurred. And that's okay, because obviously these indicators work that way, and that's fine. And of course, as we said, the ADX is not used to trigger new positions. Instead, its primary purpose is to confirm the strength or confirm the weakness of a trend, and that trend could be up or down. Advance decline line. The next indicator we'll talk about is the advance decline line, or the ADL. And this is another indicator that is used to measure the strength of a trend. Okay? And again, I haven't shown you the calculation here. This one is actually not that difficult to calculate, but it requires data that we don't necessarily have. It requires lots and lots of data. So we're not going to show you, but again, you can look this up and you can calculate this yourself very, very easily. And what this is actually looking at multiple stocks. Alright, so usually we use the ADL on a stock index, okay? And what it does is that we compare the number of rising stocks and the number of falling stocks on any given day. So we know that the index is comprised of a certain number of stocks. And the number of stocks that are rising in that index versus the number of stocks that are falling in that index, we use that to create this advanced decline line, or to create this indicator. So if we have more rising stocks as compared with falling stocks, we'll have a rising ADL. If we have more falling stocks as compared with rising stocks, we'll have a falling ADL. So that's essentially how it works, right? It's looking at within an index or within a portfolio, the individual assets of that portfolio. And usually this will be the individual stocks that make up a stock index. Now, how exactly do we use the advanced decline line? Well, this again is a confirming indicator. It's used to confirm or measure the strength of a trend. When we see the ADL and the prices rise together, so if we see the ADL going up and we also see the price going up, that indicates that we are in a healthy uptrend, right? Which means that the uptrend is strong. It's backed by the fact that lots of stocks are moving up relative to the number of stocks moving down. Right? You can always wonder, for example, when you see the value of a stock index go up, let's say you see the Nifty go up on a day, well, how many stocks within that actually went up? Was it more went up as compared with went down, or did more go down and fewer go up? Right? So this is really what this is trying to measure. It's digging inside that index, inside the components that make that index. So as we said, if the ADL and the price rise together, that indicates a healthy uptrend. And likewise, when the ADL and the price fall together, it indicates a healthy downtrend, right? So if the ADL is moving in the same direction as the price, that's a good thing. That means the trend is strong. Now, whenever we have a divergence between the ADL and the price, then that indicates a weak trend. So if we see the price going up and the ADL going down, or we see the price going down and the ADL going up, we should expect the trend to stop or reverse, right? That's an indication of an unhealthy trend. So if we have the ADL going up and the price going down, it means that most of the stocks in the index are going up, even though the overall index is falling. That's not sustainable, and that will reverse. And that's really the logic of the advanced decline line. Parabolic SAR. Parabolic SAR, the SAR here stands for stop and reverse, is another trend indicator that we're going to talk about. This is the last indicator we'll be talking about in this lecture. And the SAR actually is on Yahoo Finance. It is available on this free technical software, so we'll actually show it to you in Yahoo Finance. And like with the previous indicators, it is a fairly complex calculation, so we're not going to go into the calculation. I would recommend just using this on the chart if you're interested in using it. And what it is used for, it is used to find exit points for long and short positions. Now, most of the indicators we've looked at, in fact, all the indicators that we've looked at so far are about when to enter the market with a long or short position. Right? When do we enter the market? Well, the parabolic SAR is going to do something a little different. It's going to be used to find an exit point. So it's going to tell us when to exit the market, right? So if we hold a long position, when should we get out? If we hold a short position, when should we get out? So often we can use this to set our stop losses, right? If we want to set our stop losses, know when to get out, then the parabolic SAR is useful for that. Now let's think about the general rule of the parabolic SAR. Now when the price is above the SAR, so the SAR will be plotted as points above or below the price. Now when we see this on the chart in Yahoo Finance, we'll see this in action. The SAR is actually going to be either below or above the price, and we'll be looking at the price in relation to the SAR. So let's say the price is above the SAR, right? So the SAR, let's say, is below the price. Then that SAR value represents the exit point for a long position. So if we already hold a long position, then that SAR value that's below the price, below the current price, would represent where we should exit. Alright? And likewise, if the price is below the SAR, so in this case, let's say the SAR is above the current price, that would indicate where we should exit if we hold a short position. Okay? And if we hold a short position, that exit point is going to be above the price, right? So you can think about where we would set our stop loss. We can use the parabolic SAR to help us to determine where to set the stop loss. Now, in some cases, people do use the SAR for entry points. So you can, instead of saying using it to exit a long position, you could equivalently say to use that to enter a short position. Or for the SAR point that tells you the exit for a short position, you could just as well use that for the entry for a long position. So you don't really have to use it for exit points. You can also use it for entry. However, it is the case that the majority of the time, the parabolic SAR is used to find exit points. And I want to talk briefly about the word parabolic here, just so we can understand what this means. A parabola, if you remember from your math classes, whenever you took those, a parabola is essentially a curve that starts one way and then goes into the other direction. So either it starts going downwards and then continues upwards, or it starts going upwards and then comes downwards. And the parabolic, just in this case, refers to the shape of the SAR. So the points that the SAR represent on the chart are normally in the shape of a parabola, right? So it's parabola is kind of like a U shape, either going up or it could be reversed as well. And that's why it's called the parabolic SAR. So it's not anything else. It's not really otherwise important why it's called that, but just so you know, it's just to do with the shape of the curve on the graph. And now what we're going to do is we're going to go into Yahoo Finance and we'll actually look at this. We'll plot the parabolic SAR and see how we would use it for our entry points. For our exit points for long positions as well as short positions. Parabolic SAR. Again, here we are back in Yahoo Finance and we have the Nifty chart up. So we still have these MACD indicators here. I'm just going to take those out. So I'll go to technical indicators, click on MACD and remove. So we start with a clean chart again. Now, if you go to technical indicators, you will see the parabolic SAR over here. Alright? And these two step periods, 0.02 and the max step of 0.2, these are actually values that are used to calculate the parabolic SAR. I haven't really talked about them, but there's no really any need to change them. These are the default values that is mostly used in these calculations. And this just tells us the speed at which the SAR moves and can catch up to the actual price. And as I said, the calculation of this is fairly complex, so if you were interested in the calculation, then you could vary these parameters. But I would suggest just using these. Use the step period as 0.02 and use the max step period as 0.2. Okay? I click draw. And now we can see the parabolic SAR. So what you see here, so let me start here, alright? You see the parabola shape where it starts out slowly and then it accelerates downwards. And that's the case for all parabolas. So if I look here, for example, this is going upward slowly and then it's catching up even quicker, right? And that's the nature of the parabolic SAR. So you can look at these as your exit positions, as we said, right? Now, one way that you can use these is as a trailing stop loss. So let's say over here you held a short position. If the price were to reach one of these points, then you should exit the position. In this case, it does not, so you would keep holding the position all the way down. And at this point now, the parabolic SAR is down here, so you would then get out of the position. And here, for example, assuming you had a long position, then if the price were to cross this line, then that would require exiting the position. So there are instances when this occurs. So for example, over here, let's say you hold a long position, then at this point here, then you would want to exit the position. And likewise over here, you would have a long position here, you would take this all the way up, and then this point here would tell you to exit the position. So now you can see kind of what the parabolic SAR looks like. It's kind of lots of little points that go either above or below the price, and they are used for exit positions. So as you said, you can use these as normal stop losses. Another way that's very good to use this is as trailing stop losses. So for example, if I'm over here, right, let's say I'm here, I have a long position, I set the stop loss here where this parabolic SAR value is, and then as the price is going up, as this parabolic SAR is going up, I actually adjust my stop loss upwards. So that's what a trailing stop loss is. It keeps the stop loss going higher, right, and only when you hit the parabolic SAR point do you exit, right? It essentially allows you to lock in your profits as the uptrend continues. And likewise with the downtrend. So the parabolic SAR, the purpose of it, as we said, is primarily for exit points. So you're going to use it mainly to determine your stop losses, and you're going to use it if you want to have a strategy that involves a trailing stop loss. And because this is a fairly difficult one to calculate in practice, right? So on Excel, this is going to be slightly complex to calculate. It's best to do this on a chart and just gain the value from that. So if, for example, you have your long and short position, you can just determine what your stop loss is going to be by taking the parabolic SAR onto a chart.